Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks and US and European futures struggle for direction ahead of the Fed's final rate decision of the year. Traders expecting a 25-point cut later today. Taking on Toyota, Nissan shares soar on a report of merger talks with Honda, potentially creating a new Japanese car giant. In Germany, Volkswagen and union leaders are still deadlocked on layoffs and factory closures. Plus, Israel raises hopes of a ceasefire with Hamas in Gaza as officials travel to Qatar to re-establish relations with mediators. Happy Wednesday. It is, of course, Fed Day. It's all about the Fed with a side helping of UK inflation at 7 a.m. UK time and an eye on the market crisis as well, as some have characterised it over in Brazil. We bring you that story as well. European futures currently flat after 4 days of losses. S&P futures in similar territory, looking for guidance then from Jay Powell, looking for guidance in terms of the forecasts and the dot plots. Will they revise lower their expectations in terms of rate cuts for 2025? Those Fed officials. FTSE 100 futures also in similar territory. S&P futures, as I mentioned, just pointing a little higher now, up 0.1%. Nasdaq 100 futures also pointing to gains of about 0.1% after losses of 0.4% for the S&P and the Nasdaq 100 yesterday. Let's flip the board and look cross-asset then. An eye on the US 10-year T-Rowe price saying you could be looking at 6% yields on the 10-year next year, depending, of course, on the fiscal challenges of that US government. 438 right now, yields lower just by 1 basis point as we build up to that Fed decision. That is the benchmark stateside. The pound in focus ahead of the inflation data at 7 a.m. UK time. The Bank of England now expected to cut just 2 times next year. Just 50 basis points priced in between now and November of next year. 127 then on the pound, keeping the pound supportive as markets pull back expectations of rate cuts from the Bank of England. $73 a barrel on Brent, and Bitcoin having broken through 108,000, currently taking a bit of a breather at 103,000 per coin, down 2.7% so far in the session. Let's get to a major corporate story right now in Asia with global ramifications, because shares in Nissan surging the most in at least 5 decades. Take yourself back to 1974 as Bloomberg learns that the Japanese automaker is in talks to merge with Honda. For more, let's bring in Bloomberg's transport reporter Nicholas Takahashi from Tokyo. Nicholas, what are the implications then for Japan's car industry?
Well, depending on how this shakes out, this could be a threshold moment for the Japanese car industry. What we're talking about is a tie-up between Honda, Nissan, and potentially Mitsubishi, which already has capital ties with Nissan. And that trio would pit itself against Toyota's alliance with Mazda, Subaru, and Suzuki. So essentially, this would split Japan's car industry down the middle, the Honda alliance on one side and the Toyota alliance on the other. This would make for an interesting situation, not least of which would lead to competition between the two groups, but also hopefully allow them to pool resources and compete better abroad in the US, Europe, and China as well.
And China clearly is a key competitive threat, isn't it? I mean, a number of these legacy brands in Asia and here in Europe struggling to position around the competitive threat when it comes to electric vehicles and rebuild their platforms along those lines. What are you watching for next then, Nicholas?
Well, we're still waiting on details for how this partnership will shake out. And an interesting bit of information also emerged today that Honhai, also known as Foxconn, approached Nissan for a buyout of the company. That's sort of the X factor in this situation now as Honda and Nissan await their announcement, hopefully next week. But in terms of how this might shake out, we're still seeing the details emerge. But on Honda's end, the benefits aren't as clear as they might be for Nissan. Where in Nissan, the financial troubles could be sort of, the partnership could act as a tourniquet for bleeding profit. Whereas for Honda, which has been looking to scale production in North America, the benefits aren't as clear.
Yeah, well, hence the differing stock price reaction today on this story, of course. Bloomberg transport reporter Nicholas Takahashi with the details and the context. Thank you for joining us from Tokyo, of course. Let's take a closer look at the market reaction to this reported merger then, in terms of the talks between Nissan and Honda, and of course broader markets in Asia ahead of the Fed and the BOJ, with that decision from the Bank of Japan coming through tomorrow. Avril Hong standing by. Avril, let's start on the car makers of Japan on this story.
Yeah, Tom, I mean, we're seeing most of them jumping today, not just keeping a focus on Nissan and Honda, but there's this speculation, given this potential merger reportedly, what's it going to mean for the wider auto space? So a lot of the other auto stocks are also jumping in Japan. But as you talked about a short while ago, Nissan's jumping by a record by the daily limit to 24%. And this is the sense that you get of how there might be short-term financial relief at a time where this company's sales to the US and China have been really weak. Its profits have been slumping. So a boost, it looks like it could be for the automaker. Honda is being weighed down by concerns that, it essentially would be bailing out Nissan. So that's why you're seeing this mixed reaction in the share prices. If you flip the board, and let's take you through what we're seeing in the rest of the region, in the broader benchmarks, because it is, after all, that countdown to the Fed and the BOJ. So it's a mixed bag. Trading volumes are lower than usual this time in the session, but just wanted to recap as well what we're expecting for the BOJ and keeping a close eye on dollar yen, which, by the way, started the month below the 150 handle, and look at where it is now. It's really the central bank's messaging that makes it sound like it's not in a rush to hike. So the pricing has gone down for possibility of tightening from the Bank of Japan tomorrow, and now markets aren't even sure if we'll see one in January. We're going to be keeping a really close watch on what Kazuo Ueda has to say. Tom.
OK, maybe a bit of reluctance to go again from the Bank of Japan, at least in the near term. Avril Hong in Singapore. Thank you very much indeed. Let's get back to the central bank action with a focus, of course, on the Fed. That rate decision later today. Let's bring in Bloomberg's Valerie Teitel for a preview. Valerie, what are you going to be watching for? Expectations, clearly, they're going to go again with 25 basis points. Does that put the lens on what we hear from Jay Powell and those forecasts?
Yeah, you're exactly right there, Tom. A lot of the market focus is going to be on those projections and just how cautious Powell sounds about the rate path cuts ahead. They are widely expected to lower interest rates for the third time this cycle to 4.5%, taking the cumulative rate reductions during this easing cycle to 100 basis points since they started reducing rates earlier this year. They are due to signal that they see less cuts needed in the path ahead, especially when it comes to 2025. They currently had penciled in 4 rate reductions for 2025. The market consensus is for them to signal that there might only be 3. A hawkish surprise would be them signaling in that dot plot that there's only 2. But again, in the press conference, the market will be listening to Powell's tone on just how cautious he wants to move on the rate path ahead. Remember, we have the looming Trump presidency and perhaps a change of economic policies when it comes to tariffs, when it comes to deregulation, perhaps muddying the clear picture for the Fed when it comes to their economic projections for next year. Let's flip on and just take a look at how the infamous dot plot could shift in the projections that they release alongside the rate decision at 7 p.m. tonight. Focus again is going to be on this 2025 dot. Just how much higher will it shift? A hawkish surprise, Tom, will be them penciling 2 cuts. Another surprise we could see in the 2025 dot is the dispersion widening, showing that there are some at the FOMC who are very concerned about the resurgence of inflation next year. If we do get a hawkish surprise in the dot plot, keep an eye on the dollar. Let's flip on, just talk a little bit about that, because the dollar is very close to hitting all-time highs, just under 0.5% away from being at the strongest level this year. A resurgence in dollar strength, Tom, could be something that could dent the equity rally into year end. So keep an eye on the Bloomberg dollar as we get the Federal Reserve rate decisions at 7 p.m. tonight. OK, prepare yourself potentially for a hawkish surprise from this Federal Reserve, from 4 to 2 in terms of the projections, with a big question mark as to the Trump policy agenda and how that changes those forecasts going forward as well. Valerie Teitel, thank you very much indeed, setting us up for the Fed on a big day, of course, its final decision of the year. Switching focus to geopolitics right now, Israel and officials in that nation say a ceasefire in Gaza is a more realistic prospect now than at any time
in the past year. Bloomberg has learned that a working group from Israel is in Doha this week to re-establish relations with mediators in the event of a breakthrough in negotiations with Hamas. For more on this, let's bring in Paul Wallace, Bloomberg, joining us from Istanbul. Paul, what do we know at this point in terms of the discussions? What is giving Israeli officials at least modest optimism at this point?
Hi, Tom. And I think a lot of it is to do that. We've got to the point now where both sides really want a deal. Hamas has also sent out pretty optimistic messages saying a deal can get done if Israel doesn't add any more demands to those on the table at the moment. In Hamas's case, I think it's exhausted. It's shattered after about 14 months of war with Israel in the Gaza Strip. It's been decimated as a military organization, and it does seem to have weakened some of its earlier demands, one of them being that Israeli forces leave the Gaza Strip as soon as there's a ceasefire. It now seems as if it's willing to accept that Israeli troops will remain in the Gaza Strip, at least in some parts of it, during a ceasefire and maybe even beyond that. In Israel's case, there is a sense in the country that Donald Trump wants a deal before he gets to office on January the 20th, that he doesn't want to be dealing with a war in Gaza in his early days when he returns to the White House. So all those things are coming together. There's still lots of obstacles to overcome. There's no guarantee of a ceasefire. We've been in this position, as you well know, many times before in the last sort of 6 months. But it does seem as if we are potentially very close to a deal.
Yeah, as you say, it's been something of a grim Groundhog Day, hasn't it? But hopefully the needle is being moved in the right direction. So we continue to watch developments, of course, on the ground. Meanwhile, Paul, the Israeli Prime Minister Netanyahu, who you've been discussing, of course, in relation to these negotiations, has also said that Israeli troops will be in this, what they describe as a buffer zone inside Syria for the foreseeable future. How significant is this?
I think it sort of confirms what a lot of people in Israel and beyond already thought would be the case. Soon after Bashar al-Assad's downfall in Syria early this month, Israeli troops moved into this Syrian side of a military buffer zone. They said they needed to do that because they didn't know about what the intentions of the group that took Damascus, the Islamist Sunni organization HTS, were, and they were worried that chemical weapons stockpiles of the Assad regime would fall into the hands of extremist Islamist groups and be used against Israel, potentially. Israel obviously went further. It carried out mass strikes across Syria, sort of damaging the Syrian military. And these comments by Netanyahu, on the one hand, from Israel's point of view, you could say, well, they need to say they'll be there potentially for the long term because Syria's political situation is still so fluid and it's very unclear what exactly is going to emerge in Syria in terms of a government and just how friendly or unfriendly it will be towards Israel. On the other hand, I think these comments will be controversial, certainly within Syria and the Arab world and perhaps many Western countries. There's a feeling that Israel does not need to send troops into Syrian territory like it has, and it would be perfectly safe if those troops were still within the Israeli-controlled parts of the Golan Heights.
OK, Bloomberg's Middle East and North Africa editor Paul Wallace, thank you very much indeed. An important update from that region. We're going to be speaking, by the way, with US Secretary of State Antony Blinken about the Middle East, as well as Ukraine and the foreign policy transition under a second Trump administration. Do not miss that interview tomorrow, 1:15 p.m. London time. Here's what else we'll be thinking about today, 7 a.m. UK time. We will get the inflation data out of the UK as traders increasingly phase out bets that the BOE will go aggressively next year. Just 2 interest rate cuts now priced in. for the BOE by traders between now and November. Let's see if the inflation data changes that. 7 a.m. UK time, we will break that live for you. 10 a.m. UK time, we're going to hit the euro area inflation. We'll break that for you as well, give you the context. The ECB taking a very different route, of course, the BOE, at least at this point. And at 7 p.m. UK time, it's the big one. Drum roll up to the FOMC rate decision, the final one of the year. It's all about those projections, forecasts, and the press conference from Jay Powell, given that it's fully expected by the markets to cut again by 25 basis points. But do they pause in January is another question. Coming up, the man leading polls ahead of Germany's elections in February proposes cuts to migration and social spending. Pretty significant as well. 100 billion euros. More on Friedrich Merz's plans next. We bring you an update as that election campaign gets into full gear in Germany. Stay with us. This is Bloomberg. Welcome back. Now, Germany's Conservative candidate for Chancellor, Friedrich Merz, has proposed cutting 100 billion euros for migration spending and social aid in an effort to fix the country's finances. The CDU leader is leading polls ahead of February's elections. Let's get more from Bloomberg's Germany bureau chief, Christoph Rauwald. Christoph, what more do we know about Merz's plans when it comes to the economy?
Well, he mapped out some initial details of like several proposals, one of which you just mentioned, Tom. That was the pretty significant cutbacks in social welfare spending and costs for basically accommodating immigrants. He also talked about the potential reduction of taxation for companies, a mild reduction from what he like mentioned yesterday. But still, I think it's worth to note that this is like pretty early days. Still, these are merely proposals. The whole concept is not very detailed at this point in time, but it just definitely goes to show that the election campaign is really kicking off right now. And yeah, we're going to see like a lot more commentary basically on the exact proposals and also how he wants to finance some of the significant investments that he also mentioned yesterday to modernize, for example, Germany's crumbling infrastructure.
Well, talk to us about more of the dividing lines between Merz and Scholz of the SPD, the current Chancellor, of course, who it appears to me seems to be one of the few who is actually talking about reforming this controversial debt brake in Germany.
Yes, that's one of the main sort of differences between the two candidates. Friedrich Merz has sort of a couple of weeks ago actually indicated, intentionally or not, that he might be willing to reform or modernize the debt brake, like the limit on net borrowing that Germany has baked into its constitution, whereas Olaf Scholz has very clearly said, look, we'll need to sort of address that and take a closer look at this because there are all these like pretty enormous financing needs for infrastructure, for retooling the economy from a sort of less sort of old like style industry footprint to more like sophisticated state-of-the-art technology footprint. And that is something where the two sort of views from the conservative candidate and from Olaf Scholz as a social democrat are very much diverging. And the debt brake will definitely be one of the most sort of contested talking points, I think, in coming weeks.
Christoph, what do the polls tell us right now in terms of who's leading and what the likely coalition makeups may be? Because ultimately, these parties are very likely to be in some form of coalition.
That's exactly right. At the moment, the Conservatives of Friedrich Merz are leading in the polls. They're just over 30%. The Social Democrats are currently in the third place, just below 20%. And you're right. That's one of the really critical points to see in the next coming weeks as well. The main two options basically to form a coalition would be for the Conservatives to either team up with the Social Democrats of Olaf Scholz or with the Greens party. That could, however, be pretty complicated because parts of the Conservatives have pushed back very strongly against some of the energy policies in particular that the Greens have floated. So there is a pretty strong chance that, from a current point of view, from like what the polls are showing now, that the Conservatives of Friedrich Merz and the Social Democrats Olaf Scholz will have to come to some sort of agreement at some point in coming months if they were to form the new government.
OK, Bloomberg's Christoph Raold with the update in terms of this election campaign that, as he says, is well underway now in Germany. Joining us live from Berlin. Thank you for the update. Staying in Germany with a focus on what's happening in the corporate sector, VW's management and Labour leaders are yet to reach a deal after 2 days of negotiations over proposed layoffs and factory closures. The IG Metall union says it is prepared to vote at the end of the week, potentially paving the way for 24-hour walkouts across VW factories in January. Workers have already downed tools on 2 occasions this month. Stellantis, meanwhile, has vowed to replenish its Italian plants with new models over the next few years, with the car maker planning to invest €2 billion in the country next year. It's part of a push to repair relations with the government and union leaders who have been infuriated by dramatic declines in production. Coming up, investors will be paying close attention, of course, to the Fed's guidance on the policy outlook for 2025. We discuss that and more with Alexandra Ivanova, fixed income fund manager at Invesco, views on how to position into 2025. That conversation is coming up a little later in the show. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Wednesday. Now some other stories making the news today. Luigi Mangione has been indicted in New York on first-degree murder charges for the shooting of United Health Group executive Brian Thompson. Prosecutors elevated the case to first-degree murder, a charge reserved for the most abhorrent conduct, such as killing a police officer or terrorism. Prosecutors say there are indications that Mangione may now drop his objection to extradition from Pennsylvania. He faces life in prison without parole if convicted.
This was a frightening, well-planned, targeted murder that was intended to cause shock and attention and intimidation. It occurred in one of the most bustling parts of our city, threatening the safety of local residents and tourists alike, commuters and business people just starting out on their day.
Switching focus, and President-elect Donald Trump's special envoy for Ukraine and Russia plans to visit Kyiv next month and would be open to meetings in Moscow if invited. Bloomberg understands that Keith Kellogg also plans to travel to London, Paris and Rome, the source adding that the trip will be focused on gathering information rather than implementing any specific policy goal. And US congressional leaders have unveiled a stopgap spending bill to keep funding the government until March and prevent a partial shutdown after Friday. The bill provides $100 billion for natural disaster relief and another $10 billion for farmers. But some conservative Republicans say the add-ons are unnecessary. Coming up, panic sweeps Brazilian markets amid ongoing fiscal woes. We bring you the latest next on the turmoil in Brazil. That's coming up. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Taking on Toyota, Nissan shares soar on a report of merger talks with Honda, potentially creating a new Japanese car giant. In Germany, meanwhile, Volkswagen and union leaders, they are still deadlocked on layoffs and factory closures. Asian stocks, US and European futures struggle for direction ahead of the Fed's final rate decision of the year. Traders expecting a 25-point cut later today. Plus, Israel raises hopes of a ceasefire with Hamas in Gaza as a working group travels to Qatar to re-establish relations with mediators. Markets then are looking for direction. It is the build-up to the Fed decision, and it is the particular focus on those Fed forecasts, the dot plot, in terms of whether or not they revise those lower. The expectations from September had been for 4 cuts in 2025. There is now the view that they pull those in to possibly 3, even possibly 2 for 2025. So scrutinising the dot plots, scrutinising the forecasts with a cut today, all but entirely priced in by these markets. European stocks flat. FTSE 100 futures in similar territory, looking to add just 4 points. And in terms of S&P futures, after downside yesterday, 0.4%, looking to add just 0.1%. Nasdaq 100 futures pointing in a similar direction, pointing higher by 18 points after a drop of about 0.4 yesterday as well. Let's flip the board and have a look cross asset. Then the focus on the Treasury curve and the 10-year, with T. Rowe Price saying you could get to 6% on the 10-year in 2025, depending on how the policy agenda of the Trump administration comes to bear. 438 is what's being yielded right now on the benchmark. Yields down just 1 basis point, close to 2. The pound in focus ahead of inflation data expected to lock in expectations that the Bank of England will go very cautiously indeed into 2025 on rate cuts. 127 on the pound, Brent at 73.24, and Bitcoin taking a breather, having crossed through 108,000 per coin yesterday, dropping 2.5% in the session today. But let's not forget about the market chaos that is happening in a key emerging market. The sell-off in Brazil, engulfing everything from stocks to dollar bonds, with traders piling in to hedges against a sovereign default. This comes as the country's lower house approved the first part of President Lula's plan to target $11.5 billion in spending, with changes that water down some efforts to address investors' concerns over Brazil's public accounts. For more, let's bring in Bloomberg MLive strategist Mark Cranfield. Mark, Brazil's central bank then intervening aggressively, doesn't seem to be doing much for the currency. What is happening in Brazilian markets?
This is a classic case of investors thinking that the central bank and the authorities in general are well behind the curve in trying to address the concerns that investors have. So obviously, the bottom line here is that the fiscal deficit has been allowed to get way too big. Brazil needs to rein in its spending. There isn't enough evidence of that, even though they've just passed a new bill. It's still a huge deficit. People have totally lost confidence in all kinds of Brazilian assets. And now the central bank in particular is doing a catch-up game that's trying to restabilize markets, but it just isn't doing enough in the eyes of investors. So, for example, it recently increased interest rates by 100 basis points, and yet traders are looking for them to increase by 400 to 500 basis points. This is beginning to smell a bit like the Turkish lira. We've seen over the past couple of years, there have been periods when the Turkish lira almost became untradeable because people just wanted to exit those markets. Now, the advantage that Brazil has, it's a huge part of the emerging market complex, as you said. So at some stage, on a relative basis, Brazilian assets are just going to look so cheap compared to the rest of the emerging market world. We may have reached that already, but it needs a trigger to get people back into the market. And it's just the wrong time of year. We're coming towards year end when people want to go with cleaner positioning and they don't want to be carrying over bad exposure and such as they may be thinking about in Brazil. So we're running wrong time of year for people to be putting on fresh positions. Stock market is massively underperforming as well. Currency is in practical free fall and nobody wants to be in the bond market as well. So really it's a question of now, do you want to wait until January when maybe you have a longer runway, some fresh ammunition, and possibly by then people are a little bit calmer about the whole situation?
The whiff of the Turkish lira. You went there, Mark. 400 to 500 basis points, 4 or 5% additional rate increases expected from the markets when it comes to the Central Bank of Brazil. What could that trigger be? What could the signal be then that investors are ready to get back into this market?
Typically with these beaten up markets, it's the equity market which turns the first. So if people come in January, they're looking ahead for the year ahead. They're looking for the most undervalued equity markets around the world. Brazil is certainly going to be near the top of the list if we don't have a major improvement between now and then. And equity guys are normally the most optimistic. They're the ones that will put money to work before other people do. So it could well be that when we come in at the beginning of next year, some emerging market fund money will start to think, well, Brazil just has to have some potential here. The currency is very undervalued. It's a commodity story. There could be an improvement globally there. The equity market has underperformed the MSCI World Index by such an enormous amount that it is undeniably cheap on that basis. And you would think that the government could improve. Maybe Lula's health will improve as well. He'll get back to work, and there will be improvements in the whole situation in terms of Brazil. Certainly, you could hardly think it could get a lot worse. It can stay bad for some time. That's another reason for thinking it's a bit like Turkey. The Turkish lira underperformed for a very, very long time. It still is to some extent as well. But Brazil is just too big to ignore. The emerging market world cannot stand back and look at Brazil for too much longer. So it wouldn't be a huge surprise if in the first quarter of next year, some funds started to move back into Brazil. Whether that's enough to turn it around completely, we'll have to wait and see. But this isn't going to go on for too much longer, surely.
OK, Bloomberg AM Live strategist Mark Cranfield on the panic sweeping Brazilian markets and what could arrest the decline with an eye on the equity markets in the new year. Mark, excellent as always. Thank you for the analysis. To a major corporate story over in France in the banking space, particularly Crédit Agricole now has appointed Olivier Gavalda as its new CEO, taking over from May. The lender has been responding to a string of potential bank deals in Italy, set to reshape its biggest market outside of France. For more, let's bring in Bloomberg's Claudia Cohen, who joins us from Paris. Claudia, let's set things up with some details about who Olivier Gavalda is and what the biggest challenges are for this new CEO.
Hi. Yeah, sure. So Olivier Gavalda is kind of like a really predictable choice because he's a company veteran. He has spent his whole career at Crédit Agricole. He was currently deputy CEO in charge of the Universal Bank. And he had a lot of experience also in the regional banks because, as you may know, Crédit Agricole's structure is quite complicated as the main structure is owned by the regional bank. I would say that his main challenges, the first one will be that he will need to elaborate a 3 years strategic plan from 2025 in obviously quite of a complicated moment for France. And also, as you mentioned earlier, he will have to defend Crédit Agricole interest in Italy, especially facing a UniCredit CEO or sale.
We've had the downgrade, of course, from Moody's on this bank, and they've been reassessing, of course, the fiscal challenges of the French government, and now with a lens on the banking space. And we know banks have been hit by the political uncertainty in France. What impact is that likely to have, the Moody's downgrade?
Well, we'll see, I guess, when markets open in France. But like the downgrade was quite predictable because obviously Moody's, they always want to keep a notch between the sovereign and the bank's rating. I would say that it's been since the summer that all the political turmoil in France have been quite integrated already in the bank stock. So we'll see. My main concern will be more in the long term if the political turmoil will have consequences on the economy, like if people spend less, if main corporates in France decide to, freeze some investment in France. But for now, investors know that French banks are solid. They have solid outlook. Crédit Agricole, for example, BNP as well, they are quite strong. So we'll see how the market reacts.
OK, Bloomberg's Claudia Cohen. Thank you very much indeed. Change at the top of Crédit Agricole and the downgrade coming through from Moody's. The implications for the broader banking space of France, of course, tying to the politics. Claudia, thank you. Now, as investors await, of course, the Fed rate decision later today, Bank of America CEO Brian Moynihan, staying on the banking space, is warning that the US economy may not need too much stimulus. Moynihan spoke with Bloomberg about where he's seeing signs of strength in that economy, including in the consumer sector.
If we were sitting here last year, our team, the research team, Candace's team, had a soft landing, no landing predicted. And a lot of people say, oh, that's very optimistic. And matter of fact, we went from that would have been like a 1% GDP growth rate this quarter, and we're going to have 2.5 or something like that. So we've moved up from abnormally, from positive but low to now higher than trend, higher than average. And so that means the economy is not having a bounce, anything. It's just going on its normal growth trend, which is good news. If you think about it becoming overheated, I think all the policies are yet to come in. There's enthusiasm and discussion, but everything's still out there until the policies get enacted. Our team, when they look at tariffs, they say, well, if tariffs are offset by better regulation, they'll kind of even each other out. But even given their knowledge of President-elect Trump's policies, they are still predicting next year's a 2.5% GDP growth. They predict the Fed cuts rates a few times. If the inflation's moving down and we can grow this economy, that's actually not a bad place to be, honestly.
Does this economy need any fiscal stimulus at this point? And it looks right now like the so-called Trump tax cuts will get extended. And also, candidate Trump is talking about a lot more tax cuts. And given the fact that we're above a trend on growth and we're close to full employment, do we need any more stimulus?
I'm not sure you need more stimulus, just like we didn't need the stimulus probably in 21 because the pandemic goes through the system. But the question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are. And that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. And he's a markets-oriented person. He knows that if it gets too far out of line. We just ran, for the last fiscal year in the United States, an operating deficit of $1.8 trillion, which is equal to the entire GDP of the country of Australia. So we got to realize that the impact we have if we don't get this debt back in line. So I think everything on one side has to be governed with whether to do on the other side to offset it and whether it has that much effect. Right now, the economy is moving along. Consumers are spending. It's up for a 2-week period around the holiday, Thanksgiving holiday. It's up 5% over last year. That is good and solid. That is not overheated at all. But that came off the lows a little bit this summer, where I was a little nervous that they were going to let the consumer drift too far down. So between interest rates being cut a little bit, between the enthusiasm around the election, the markets being up, the consumers are spending more and telling us they're going to spend more for the holidays, which is good for the general economy. We got to keep them in the game not by overstimulating, by overdoing, by keeping the game just by getting a good core economy going with good deregulation activities, good tax policy, good immigration policy. These are hard things, but I think they're off working on it.
Bank of America CEO Brian Moynihan speaking to Bloomberg. Coming up, we're going to be speaking with Alexandra Ivanova, fixed income fund manager at Invesco. We're going to get her views on where to be positioned heading into this week's big central bank decisions, of course, leading up to the Fed. Her view that being long fixed income in Europe makes sense. We'll ask her why. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, traders are readying, of course, for the Fed's final policy decision of the year, with the central bank expected to cut by 25 basis points. The focus likely to be on the outlook for next year as Donald Trump heads for the White House. I'm joined now by Alexandra Ivanova, fixed income fund manager at Invesco. Alexandra, thanks so much for taking the time. Looking into 2025 then, with a view on maybe some adjustments around the forecast and the dot plots later today from the Fed, what is your expectations? Do they dial back from 4 to 3 or go even further?
Well, our view is that they probably will dial back. I think 3 makes sense. If they do 2, I think the market is not going to like it. It's probably going to be too hawkish in terms of messaging. But given that Fed has a tendency to surprise us in December, like last year we had a big pivot to being bullish, I wouldn't discount that they might not do it. But my expectation is that they will review and recalibrate their final dot, and also I think taking out a few cuts from the dot plots for next year. Just one maybe makes a lot of sense to me.
Okay, so maybe dialing back from 4 to 3 in terms of those projections, yes, with the caveat that there's some uncertainty around this decision later today. Do the projections really hold up? I mean, what value do we give those projections given all the uncertainty around Trump tariffs, taxes and immigration?
Well, what I tell clients is that given the range of outcome has really extended both on the upside and the downside, the uncertainty is very high. And we ought to be quite humbled as investors because, as you have seen in 2024, we have kind of ping pong from a lot of cuts and then taking those cuts out and then putting that back in. So in terms of what is actually going to happen in the future, it's very uncertain. But it's not a bad environment for active investors like ourselves. We have been quite active in terms of trading the rates environment and coming into elections quite light on duration. That was probably one of the best decisions that we had. But at these levels, I would say carry is important. The level of the rate is probably good enough for us to be neutral, I would say. And then in terms of the curve allocation, I do like it in the front end up to 5-7 years. And then anything else further down the curve, I would think that being active on that side makes a lot of sense to me.
Okay, you like the front end, be active towards the back end. T. Rowe Price coming out with a view yesterday that yields on the 10-year could hit 6%, on some fiscal challenges in the US. Does that seem do we need to brace for a bigger sell-off in this bond market?
I personally don't think so. It is quite outrageous and a big forecast, of course, and it's a headline grabbing. But I don't think that we will get there. And if we do, we will be looking at a very different environment for investors, and risk market is definitely not going to like it. And in that environment, I would think that the Fed will have to cut even more than we are expecting. So I think gradual increase in rates is probably bearable for equity markets, but anything that comes up very quickly, if the rates react quite aggressively, that is also a risk for equity and credit markets.
So where are you finding value in credit at this point?
Well, we do like European credit. It looks relatively attractive relative to other credit markets. Also, the quality of credit indices in Europe tend to be much better. And being selective, it's a great place to be where you can put your money to work in companies that you believe in. And overall, yields are still attractive. We have ECB potentially continuing to cut into next year. That is very supportive for credit and fixed income assets in general. And I also think that, yes, the spreads are tight, but I think we are probably focusing too much on spread, not on yield. But for total return investors, if you are investing in credit, I think the overall yields in 4, 5, 6% area looks very attractive to me.
Okay, so that's the case for European credit. With a lens on the UK, what do you do? Is there a risk of a pain point coming for UK credit with the BOE moving much slower? At least that's the expectation for markets.
Well, the sterling credit already trades with some premium, so I think it's not going to make a big difference in terms of where we trade from here. And again, sterling is the market where I think having slightly lower expectations on growth, but the inflation coming up or being quite sticky is a great environment for credit because you can sit and clip your coupons, do your credit analysis. There are really interesting situations out there. I think being also selective means that avoiding places where there are potential problems to come, and that's the way to outperform the market, because from the top-down perspective, you might see that all the credit markets look very expensive.
Okay, Alexandra, Ivanova, thank you very much indeed. Fixed income fund manager at Invesco on the case for European credit and the need to do your homework, bottom-up research when it comes to the UK market where there are still opportunities, and a view, of course, in terms of what to expect from the Fed, with the forecast maybe coming in from 4 cuts next year to 3 would be appropriate. That is the view, at least. Plenty more coming up. I'm going to break down what to expect when it comes to the Fed and give you a preview as well of the inflation data coming up in 8 minutes out of the UK. Talking of the BOE. Stay with us. This is Bloomberg.
but I think they need to bring it down a little bit. They just have to be more careful because the economy is stronger than we thought 3 months ago, 6 months ago, but it still has potential weaknesses. You and I haven't even talked about what's going on outside the United States that could affect the United States. Not tariffs and stuff, but wars. What happened in the Middle East this week, what happened in Korea, what's happened in Germany. All these political changes could impact the United States.
OK, Bank of America CEO Brian Moynihan, of course, there on the potential external risks facing what is otherwise he describes as a resilient US economy. The need, he says, for the Fed to go with caution, but with an eye on those potential external shocks. So we lead up, of course, to the Fed decision, fully expected by the markets to cut by 25 basis points. So the lens will be on what we hear from Jay Powell as he pushes into 2025. And, of course, revisions to the forecasts. And we break down, of course, in terms of growth, in terms of unemployment, and in terms, of course, the inflation picture, but as well on the dot plots. The forecasts, which in September looked at 4 cuts next year, will they be pulled back to 3? Markets expecting around 3 cuts now, fewer than 3 priced in between now, and October, about 70 basis points as things stand. Let's flip the board and look at that pricing then when it comes to the Fed. Again, 25 basis points fully expected today. Do they pause in January? That is the market view at this point. Let's get those projections. Expected to pause in January. Again, just 70 basis points between now and October of next year. And to what extent are those forecasts valid anyway, given all the uncertainty around Trump when it comes to taxes and tariffs and immigration? To what extent and for how long will those even hold any water? This is the projection then in terms of where things go on rates when it comes to the Fed. Cutting today and a pause in January is the market view, at least at this point. Let's flip the board and have a look at the story when it comes to inflation in the UK, because talking about adjustments around views on central banks, markets now expect just 2 cuts between now and November of next year from the Bank of England on stronger wage data, with the inflation story build on that. The headline number expected to tick up from 2.3 to 2.6%. Keep an eye on services. That has remained stubborn, 5%, and that for the hawks is the problem. That has lifted the headline number back above the target of 2%, currently at 2.3%. The core above 3%. Services is sticky. That is a challenge. We will be breaking that inflation data for you live in just the next couple of minutes at 9:10 a.m. UK time, though. After that, we're going to speak exclusively, by the way, to the CEO of AXA, Thomas Burbel. Coming up, though, it is the opening trade. They're going to break that inflation data for you. Stay with us. This is Bloomberg.